Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning, and I've been helping clients with their inheritance tax issues for more than 18 years as a specialist, and we've saved hundreds of clients millions of pounds over their inheritance tax and estate planning. So today's video is around an employee benefit trust and how is that utilized and when, and what are its advantages for people with inheritance tax issues. Hi, and welcome back. And today's video is around an employee benefit trust. How is it used? What's its purpose? Why would somebody want to consider it? The main benefit of an employee benefit trust is that after we've set up family investment companies for our clients, many clients have got large capital gains tax issues embedded in the shares, the capital shares of their company. The reason is because how it works, and this is specifically to do with people who own large property portfolios. So let's say we had a client who bought property for £500,000 and now over time it's worth 2 million, right? So they've made a significant gain on their properties. So we're suggesting to them that they transfer those properties into a family investment company. If they own the properties personally, they put it into a limited liability partnership first. There's no capital gains tax generated in that point, and then when it's also passed, and no stamp duty land tax either, because you're not transferring the property, you're just effectively registering a partnership and sending a tax return to HMRC, but then you're sort of saying this is a business and not just some property I own. Okay, so then when you transfer into the family investment company, again, you claim incorporation relief and you don't pay any stamp duty land tax and you don't pay any capital gains tax. But how it works is that effectively the initial setup cost or the initial setup value of the shares in the company is the original purchase price of the properties, which is £500,000, right? But then if you disposed of those shares the following day, the actual value is the value of the properties, which are 2 million. So in some cases with clients, they don't need the income from their property portfolio and they're relatively young, and we would dispose of those shares into a normal discretionary trust. And there are principles like RISAF which helps keep the ongoing taxes down. Watch my video on the RISAF principle. Okay, but for other people, they're older and they need to get these capital shares out of their estate as quickly as possible without generating the capital gains tax. So then we suggest an employee benefit trust, and basically it's a special mechanism where you make your children or grandchildren or both, if the grandchildren are over 18, employees of the company, and you gift those capital shares to the employee benefit trust and you use holdover relief into that trust, and therefore no CGT is realised, and because it's a transfer of shares and not property, there's no stamp duty land tax issues. So the shares now all go into the employee benefit trust. And the anomaly of this particular trust also is that it's immediately outside of the estate. You don't even have to wait the 7 years. Now, effectively, the capital gains isn't lost. It's still embedded in those capital shares. So, you know, but how long can you leave it and let just inflation take care of the actual tax issue, the entire length of your children's lives and possibly your grandchildren, as long as the company continues and that employee benefit trust continues, the CGT isn't realised. But of course, then if you've got enough employees, you can pass some of those capital shares out to the people personally and utilise their capital gains tax annual allowance, and slowly but surely over 50 to 60 years you can get rid of the majority of the capital gains. The main point is that you can get the value of your property portfolio outside of your own ownership, thus meaning you're not paying the inheritance tax, but you're also not paying the stamp duty or the capital gains tax. And therefore, for older people who need to get their shares outside of their estate faster, or the share value is very large, then an employee benefit trust is extremely useful. Okay, hopefully that helps. Thanks for listening, and bye for now. Bye.